happy Diwali to all the viewers in advance. And this is the time when we do Know Your Company. I am Hiral Datia. With me is Varsha Chandani. What's interesting is today we're going to talk about a company which has been slightly under pressure right now. And that the main reason for that is the pricing pressure that the sector is facing. Yes, we're talking about a company from the chemical space. Rossari Biotech, that's the company that we're talking about. Let's first understand, what do we want to know from the management? First up, what is the pricing pressure looking like now? Is it easing or not? And will they see the volume growth back in action? That's the first aspect. Moving on, what is the target looking like when it comes to EBITDA break-even, specifically in the institutional business, because the margins are something that we need to watch out for, Varsha.
Also, Hiral, I would want to know how's the outlook when it comes to their export business, because Q1 saw some subdued demand, but they are back with growth when it comes to Q2. What's the outlook ahead? Will they sustain this growth? Then I would also want to know, is company seeing an improvement in margins, because we all know what chemical industry is being going through, and that is evident from their pressure in margin. So outlook on margin. And lastly, what are their expansion plans and how these expansion plans will be funded?
Interesting questions for us to ask the management. But first up, let's quickly look at all that we know about the company. Rossari Biotech is in the manufacturing of specialty chemicals in India. When you talk about their three main product categories, you're talking of home personal care and performance chemicals. That's the HPPC category, as we call it. Textile specialty chemicals, that's the TSH. And you're talking about animal health and nutrition. These are the three segments that the company caters to. And from the three, HPPC, that's the one which contributes majority. 78% of the contribution in terms of revenues comes from there. And then it's TSC, which contributes the remainder. Animal health is around 5% right now.
And I would also want to pull up the chart when it comes to their export business as well, because if you see, that contributes 28% to the overall revenue, and exports have increased year on year. And we would want to know what is the expected contribution, over the next few years that the management want to take. So onto the geographical contribution, 72% comes from domestic, while almost 28% comes from export. So where this number management want to take to, because this is a high margin segment, so we would want to know on the export side also.
Okay, with that, Q2 earnings probably give you some bit of a trend, right? The revenue that has come in from the volume growth, which is a key positive that we need to watch out for. In terms of the three segments, 16%, 21%, 29%. That's the kind of growth that they've seen. And what's interesting is animal health has seen the maximum growth that has come in there. The profits have been steady as well, but that's only on the back of subdued pricing and ongoing investments. When you talk about the institutional and B2C performance, we have seen growth that has come in the institutional business as well, but B2C business has remained muted in this quarter. The losses, in fact, have narrowed on a sequential basis, so which is a positive for the company as well from here on. And,
also the capacity expansion plans, let's pull up that also, what company is doing. They've commissioned additional 20,000 metric tons per annum at Dahej, and also the total capacity now, if you see, stand at around 152,000 odd metric tons per annum. And their phase 2, rather the unit of which they also started 15,000 metric tons per annum of ethoxylation capacity at Unitop, which they acquired in 2021. And all this expansion, out of which the phase 2 will be commissioned by 23, and all this expansion, if you see, will lead growth when it comes to their personal care, agrochemicals and pharma. And also board has also approved almost $8 million of investment when it comes to their Saudi subsidiary as well.
Okay, interesting commentary here from expansion as well, Varsha. But let's tell our viewers all our rating parameters that we are considering over here. First up, you're looking at, the income statement check, balance sheet, cash flow, return ratios is what we will consider. Street credentials, valuations. Along with that, when you're talking about street coverage, the outlook also becomes absolutely important. So with this company, we're going to look at the outlook that the management has indicated so far. But first up, let's decode the income statement. Now, if you have to look at the last couple of years from FY18 to FY25, it's reflecting a company which has been in a significant expansion and integration phase. Now, the company has successfully scaled its revenue manifold, which establishes a larger and more diversified presence in the specialty chemicals market. The challenge being that the expansion has come in at the cost of margin compression. The key for future, analysis will be the company's ability to drive this margin recovery through operating efficiencies, product mix optimization. I mean, they will have to look at higher margin offerings as well, and the synergies that could be coming in from the acquisitions. Now, the moderate growth that we've seen in the net profit in FY25 compared to the revenue growth, also indicating that the cost management and margin expansion remains critical focus areas for the company. And pricing pressure has been a concern. They've actually gone ahead and said that the growth has been trimmed over the last 2 years as well. And to add to this, the key will be when do they actually see that pricing coming back, and the way volumes have increased this time around, will they see it going further from here on, and hence a neutral rating on the income statement?
Well, talking about balance sheet, not much surprise here, because though if you see the, borrowing has gone up from 74 crore to 188 crore, but this is well within the limits, so not much surprise when it comes to borrowings. Even cash in bank, if you see, was 124 crore in FY23, fast forward to FY25, stand at around 57 crore. But overall, a thumbs up when it comes to a balance sheet, because if you see debt to equity ratio also is well within the limits, so not much, aggressive debt that the company has taken. So overall, a thumbs up when it comes to balance sheet.
Okay, so that's with regards to where the balance sheet goes. Now, let's understand the cash flow statement as well. Now, overall, you will not see any major issues coming in here. But if you're talking about FY24, the cash flow from operations was lower, but that was mainly on the back of the increase that the company has seen from the receivable front, which has actually impacted the cash flow from operations. And on top of that, the company also made an investment. So your net cash flow is seeming to be negative in FY24. But from there on, if you talk about a net cash flow of almost 19 crores, this is on the back of the investment of almost 183 crores that they have made, out of which majority has been in fixed assets worth 159 crores. And hence, we've given it a thumbs up so far, Varsha.
Right. And on to ratios, let's pull up that chart, how return ratios have been fed for the company. So in FY22, the ROC, that is return on capital employed, was almost 24%. Fast forward to FY25 is at 17%. Even if you see ROE, that is return on equity also, there also if you see that that's from 16% to 12%. So yes, we have seen return ratios going down. Now why? Because of the acquisition and inorganic expansion that Rossari Biotech has done with respect to Unitop and Tristar Intermediates also. So while these acquisition, if you see, has boosted their HPPC revenue, but they have initially dragged their return ratios, and hence we are seeing the drag in the return ratios. And overall, if you see the pressure in the margins and overall the profitability pressure has also impacted the return ratios for the company, and hence we have given a neutral rating on the ROC and ROE front.
Okay, let's look at the shareholding pattern. Again, a neutral rating from NDTV Profit. Now, the only reason being is, if you talk about the promoters, they've remained steady. Your DIIs, again, that 70 to 18% is the kind of range where they have maintained in the last 3 years. Public has gone up marginally, but your FIs have actually seen a dip. It's nearly halved from a 4% to a 2.7%, or at least 1/3 of it has gone away. And that's the reason why we've given it a neutral rating.
Talking about the street cred, the investors have actually not made money in the last 3 to 4 years when it comes to Rossari. If you see in last 1 month, the stock has given only 5% of return, while in the last 6 months it's down 1.3%. In year to date, the stock is down 15%. Even in the last 5 years, the stock is down almost 13%. So now one of the reasons is, of course, because of the industry dynamics that the company has facing. We have seen chemical industry as a whole facing problems when it comes to realization, when it comes comes to pricing pressure, though volume has increased. Now we are seeing that growth in volume coming back, but China destocking and China dumping has always been the issues when it comes to chemical industry, of course, in the last 2 years, and hence, we are seeing the investors have not made money when it comes to Rossari, and hence we have given a downward rating when it comes to street cred.
Okay, let's look at what valuations are telling. It's interesting because if you have to compare, to a 3-year average, it seems very reasonable. If you compare to the peers, it's slightly somewhere in between. The reason why we've given it a neutral rating is because the expectation is of a volume uptick. And if the pricing pressure eases, these are the two aspects that analysts are, actually taking into consideration. If pricing pressure eases, please hear that carefully, because that is what probably is the reason why you're seeing a good upside, which the analysts have given the counter as well. And that's the reason why we're talking about a neutral rating so far.
Well, talking about the analyst recommendation, as you rightly said, on that upside potential, you have 25% of upside potential, what analysts are pegging in, with 6 calls of buy recommendation, hold 0 and sell 0. But as Hiral was saying, this is on the back of if pricing pressure eases. Now, talking about the outlook, when it comes to Rossari, their new capacity, EO capacity and backward integration will actually cut cost, and the expansion at the unit top and Tristar will actually add high growth chemical segment into the picture, and the Southeast Asia facility will boost exports for the company. So there, we might see that growth to be sustainable over the next few years, and the innovation pipeline will actually support long-term growth, and hence, on the overall rating, if you see, when it comes to analyst recommendation and outlook, we have given a thumbs up onto that.
Okay, so that's with regards to where the overall ratings go, but let's understand what that actually adds up to from the rating parameters. A neutral when you talk about income statement and return ratios, but your balance sheet and cash flow are a thumbs up. Your shareholding, valuation, street coverage and outlook is a neutral, and your street creds is a thumbs down, and that takes you to a 5 on 8, which is still a pretty strong rating, I would say, on KYC that's come in. But to discuss further on this and what is in store, let's get in Ketan Sablok, Group CFO at Rossari Biotech. Ketan, welcome to the show, and always a pleasure to speak to you. Wishing you a happy Diwali as well from NDTV. My first question coming to you is, we've laid down what's happened in the past couple of years. There is some bit of respite that's coming in on the volume front in the second quarter of FY26. What is the trend that you are looking at if you have to look at the next couple of quarters from volume and pricing perspective?
So yeah, thank you for having me, and happy Diwali to the entire team there. So this quarter, I think whatever growth that we've been able to do, most of it has come through volume. Pricing is a challenge for us. It's a little dynamic situation now. Going forward, also we do not have a complete clarity on how the end market is going to behave. We have issues of tariff, etc. But we're just keeping our fingers crossed that we can keep pushing the volumes. Some of our capacities, as we had said, have come on stream. Couple of new capacities will come during the forthcoming quarters. And then our target will be over the next year, 2 years to start utilizing these capacities completely. So most of the growth, as we see today, should be volume-led. Pricing is a challenge for us as of now, the way we see it, sitting today.
Note, Mr. Sablo, hi, this is Varsha, this side. Welcome to NDTV Profit. You have guided for mid double-digit growth when it comes to revenue and profit in FY26. Considering the pricing pressure that you have and considering the on-ground reality, are you still track when it comes to this guidance, or do you want to upgrade it?
No, we would not like to upgrade the guidance. We had talked about 12 to 15% kind of growth during this year. The First quarter was slightly lower, but I think on a H1 basis, we are again back on track, close to 14% growth on the top line. And we envisage that by the end of the year, we should be at the levels of 12 to 14%, coming on the back of a lot of these geopolitical situations that are happening, tariff issues, etc. Some of the demand could taper down in the coming quarters, subject to how the tariff situation folds out. But yes, as of now, we would still stick to what we had guided earlier.
And what about margins, Mr. Sablok? Where do you want to, where do you see EBITDA margins for FY26?
So I think FY26, we had guided for margins, EBITDAs above 12 to 13%. I think as of now, we would still stick to that kind of margins.
Understood. Also, Mr. Sablok, talking about your exports, so in Q1, there was a dip in exports, but in Q2, the exports grew very strong. What is the trajectory going ahead when it comes to export? Do you see this growth sustainable when it comes to the H2 FY26 and for FY27 as well?
Yes, so we've always been talking about our growth coming majorly out of exports. The exports going to outperform the domestic sales, and I think that's how the situation is currently playing out. This quarter was very strong for exports. Almost 30% of the overall revenues came out of exports. Exports grew by close to 36% in this quarter. And I think we are very confident to maintain this split of 28-72% kind of split, at least for this year. But having said that, we are seeing a short order flows are getting a little difficult from the export market, especially because the end customers are not very clear on when to order and the exact timing of the order. But we are still confident that we'll be able to track that. Also, we've done. We are expecting the Southeast Asian, the Thailand plant of ours to come on stream by the end of Q3. So that's also going to help us, especially to start with in our textile exports to the Southeast Asian markets and Bangladesh and some of the other countries, where the tariff could be an issue while exporting from India. So that should help us cushion some of the export demand, which could be lower on the Indian market. So I think we still hold on to this 70-30 split, and we expect exports to keep growing.
Okay. Ketan, you interestingly said that the 70-30 kind of split is what will continue for exports this year. Let's look at the next 3 years. How much do you plan to scale it up to, number one? Because this is something which is usually a margin accretive side of the business. So are you seeing any tailwinds then come in?
Yes, so if the plans come out the way we've laid down within the company, and some of these issues in terms of duties, etc., get rectified, I think this split is going to grow in favor of exports in the next couple of years. That's what that's how we have planned out our next move. Some of the initiatives that we've taken in terms of growing the export market, we've seen some of that playing out this year. More of it will play out in the forthcoming years also.
Mr. Sablok, on to the institutional business. You've seen losses, when it comes to institutional business. When are you expecting that EBITDA break even, and what's the outlook when it comes to this side of segment?
So if you see this quarter, the losses have come down quarter on quarter. But yes, this business needs to grow to a certain size before it becomes an EBITDA neutral and a little bit of EBITDA positive. Our internal targets are that over the next 2 years, this business should become a larger pie with at least 500 crores kind of a top line revenue, and around that revenue, we expect this business to become EBITDA positive, add some bit of EBITDA margins to the overall business, because that's when all the cost leverages will flow in. So we'll hold on to this business. We see a lot of value in this business. So in spite of this making losses in the last couple of quarters, we still are very, very positive on this.
Okay, when does it get back into the black, number one? And two, raw material price trends, how are they panning out? What's the outlook looking like?
So this, as I said, this business becomes black when we reach the top line of about 500 odd crores. That should happen the next 1.5 to 2 years. On the raw material front, I think raw material prices are stable now. We're not seeing too much of a movement on the raw material front. And that's helping us hold on to the prices. While we're not getting any price increase, but we've been able to hold on to our selling margins also.
Okay. When it comes to your capital allocation and debt as well, I mean, your recent Capex has been the hedge, the Unitop expansions, that's what we're talking about. This does lead to rising interest expenses. What's the outlook when it comes to the debt levels and the interest coverage ratio for FY26? And two, the projected return on capital employed and ROE as the new capacities start contributing meaningfully?
Yeah, so expectation is that these new capacities will start contributing meaningfully by FY28. So that's when, the peak utilization of these capacities will come through. We still need, typically chemical plants need about 2 years to peak out on their capacities. And once that happens, I think all these ratios in terms of ROEs, ROCs will start showing up. These are good products. These are high capacity, high utilization Capexes. The asset turns are going to be significantly high, so it will be all in 4+ kind of asset turns. So our expectation is that by FY28 we'll be able to peak out on these capacities in terms of volumes.
So Ketan, would you peak out on your return ratios as well? We've seen a 22% number versus a 17 in FY22. So on your return ratios, when do you peak out? Are you saying once the capacities are at full utilization, you will see those peak numbers on your returns?
Yes. So FY28 onwards, we should see a better return ratios.
Right. Lastly, I just wanted to ask about that. You said that the growth will be driven by volume, at least in the short term. What kind of volume growth you are expecting? Any ballpark range, if you could give us?
So volume growth, we expect at least 12 to 15% kind of volume growth in the short term. These capacities, once they start, partially contributing over the next year and 2 years, I think the volume growth will be very visible in our top line numbers.
Right. Well, thank you, Mr. Sablok, for answering all the questions, and all the best for the business, and happy Diwali.
Thank you, and happy Diwali to you.
So, the key takeaways, Hiral, from this interview would be: one is they're expecting 14 to 15% of revenue growth for FY26 with EBITDA margin of 12 to 13%. And they are also expecting their Southeast Asian plant to be live from Q3, which will actually drive exports for the company. And lastly, a kind of, so there's the tariff situation may actually, impact demand in coming quarters. So that
and your return ratios will peak in FY28, yes, when all your capacities will hit maximum utilization. That's the key from here on. But completely out of time. That's all, folks, that we have on KYC. Thanks for tuning in only on NDTV Profit for your profit. Lots more lined up on the other side. Please stay tuned for a blockbuster Diwali coverage on NDTV Profit.